Welcome back to the InvestTalk Classroom. I'm Justin Klein.
I'm Guerrero.
And today we're going to talk about how to gauge the U.S. economy. And this is something that a lot of people have trouble with, especially because there's a lot of headlines that people see, right? GDP numbers or inflation, and they think that's a good understanding of where the economy is going. And in reality, it's a good gauge of where the economy actually was. And that's frankly not that important to the full investment picture because, as we said many times, Luke, which is you invest through the windshield, not the rearview mirror.
Exactly. One of Steve's favorite phrases.
Yes, exactly. And so there are what are called leading indicators, coincidental indicators, and lagging indicators. Unfortunately, most people focus on the lagging indicators like GDP, like CPI, because those are data points that they make headlines, they're easy political talking points, but at the end of the day, they're reported weeks, months, sometimes quarters after the fact, which doesn't, once again, tell you a whole lot.
Yeah, and I think that people talk about them because it's what they've been feeling, right? It's not what they're going to feel, and people focus more on what they've been feeling. So people talk about CPI because they've been complaining to their neighbors for a month about how expensive it is to buy eggs, and now someone comes around and tells them, you're right, it is more expensive to buy eggs, right? GDP as well. People have been seeing their friends or themselves getting laid off, right? And they're thinking to themselves, wow, things are not good economically. And then they get told 2 months later, I was right. Things weren't good economically. So there's a little bit of confirmation bias in there, in that people are focusing on the things that tell them about how the past was rather than focusing on the things to tell them about how the future is going to be.
Exactly. And, people focus on corporate profits. That's another one that's lagging because you typically know 3, 4, 5 weeks after the quarter has ended, what that company actually did. Okay. And same with unemployment. Unemployment is one of the most lagging indicators because companies don't want to lay off employees. They do it more as a last resort as opposed to the first thing that they do, right? So it's really more about those leading indicators that are very important. Things like are builders in the housing market, are they filing for permits to build in the future? Are they actually starting homes right now and hiring workers that are going to earn money and start to spend out there in the economy? And then suddenly that also turns into finished homes that are sold. People go and they buy furniture and they do all these things to fix up their new homes. And so the leading indicators are far more important than those lagging indicators that get the headlines.
Exactly, because people plan, right? Businesses plan. Construction businesses plan. How many houses should I be selling in the future, right? Manufacturing companies plan. What should our durable goods orders be for future consumption? So the things that you should really be looking at, as Justin mentioned, are what are the things that are indicative of corporate planning, not what are the things that are indicative of corporate success or failure in the past.
Yeah, and consumer planning, right? Consumer confidence is one. If people are happy and they feel like the economy isn't on good footing, then they're going to go out there and they're going to spend. They're going to buy cars.
Whether they're right or not. That's the consumer confidence part. Consumer spending is the largest driver of GDP, right? So if a consumer feels comfortable to spend, whether or not they should feel comfortable to spend, and they go and do it, that's really what's going to start driving the economy. Same with business investment, whether or not they're right. Business investment is a large portion of GDP. So these are two things that are pretty much centered around sentiment. And a lot of these are indices that look at how people and businesses are feeling, but they're primary drivers of future economic performance.
And in some ways, it's a self-fulfilling prophecy, right? They have that confidence and you know that they're based on the past, that they're going to do X, Y, and Z in the future. Now, one way you can track that in the markets is by looking at different sectors and which ones are outperforming. But most importantly, it's the bond market. And I know that sounds boring and bond markets are fairly boring, but
bond markets are boring.
There are trillions of dollars that are invested in the bond market, and they want to make sure they're invested relatively conservatively. They want to know that they're going to get their money back. And so the signals that the bond market can send really tell a lot about what's going to happen with the economy going forward. So you have things like the yield curve, right? So if interest rates are inverted, meaning short term, that the interest rates are higher than what the price is on the yield is on the long-term bonds, that's the signal the market saying, hey, yes, the Fed has raised rates, interest rates are high today, but they're going to cut rates in the near future because the economy is going to get weaker, right? And same thing with credit spreads. So credit spreads are typically, if you're buying a corporate bond, for example, you're going to want some more premium above treasuries in order to own that, to take that credit risk of that corporation potentially going bankrupt. And so If the bond market is only demanding a small premium, then they think that everything's going to be fine, probably in the short to medium term with the economy. But if suddenly those yield spread widen out, that's a signal that, hey, you know what? There could be a lot of defaults straight ahead.
Yeah, and it's similar to evaluating a company, right? You wouldn't just go and purchase a company because you like its price to book valuation multiple, right? In a similar way, maybe you shouldn't just pay attention to a yield curve. I can count on all my hands and all my toes how many times the yield curve has been wrong in the near term about what's going to happen. So it's important to have a holistic approach, just like you should in investing, to assessing the macroeconomic environment.
Yeah, and everybody wants that one thing to follow. And unfortunately, if there was, everyone would do it, right? Everyone would do that one thing, follow that one metric and say, okay, this is exactly what you need to pay attention to know what's going to happen with the equity markets, asset markets, and the economy as a whole. Unfortunately, that's not the case, but you can build a good picture of what the future of the economy is using these leading economic indicators and doing your best to actually ignore a lot of those lagging indicators that can kind of throw you off the scent of really where the economy is headed. And that's your job as an investor, is to kind of get ahead of those things and make sure that you're not running headlong into a train, right? That's coming down the tracks, which can be a recession. But also,
we don't like that. We don't like that word.
You don't like that one?
We don't like that word. We don't say that word. It's like Beetlejuice. If you say it enough times, it'll just happen.
Right? I know, right? But it's also about getting on the train when you're coming out of a recession, and typically you're seeing the headlines, oh, GDP contracted, you're in a recession, and everyone thinks that's bad, I want to sell my stocks. But in fact, the best time to buy equities is during a recession, because the market's typically already priced that in.
Yeah, I mean, Warren Buffett says it all the time. If you liked a stock at 100, you should probably like it even more at 90, right? If it was a good deal then, and you like the fundamentals of the company, and you like what's happening at the company, its profitability, and you liked it at 100 just because it's going down a little bit, it makes it an even better value. Again, assuming the fundamentals are there, the corporate profit, like the business is running well, that's important too. Another time we'll talk about value traps, which is going to be a really important topic as well. Yeah. But in a similar way, those are important things to pay attention to.
Yeah, and like you said, it's the market might be down. We're in a recession. The headlines are X, Y, and Z, but the reality is we're eventually not going to be in a recession, and that means that there's a lot of opportunity in the market, and you want to be invested as you're coming out of recession, not when finally the headlines say there's no more recession. So I hope this helped you understand how to look at the overall economy and give you a primer on what leading indicators to look at. And if you want to learn more, just head over to investtalk.com and like and subscribe to our podcast, InvestTalk.